Last week's CPI print smashes expectations, triggering a bout of volatility across bond and equity markets. The dollar breakdown propels gold higher, and grains and copper consolidate after a huge run-up. All this and more in this week's Macro Insight. Welcome back to Macro Insight, everyone. Today is the 18th of May, and let's take a look at what's been going on in markets. So last week, we had flagged the biggest thing was going to be that inflation number, and it smashed expectations, right? So the CPI was the number that everyone cared about. It was expected to come, the median estimate was around 3.6, and it came in at 4.2%, which was pretty big beat, right? Quite surprising, given that the street was very aware of the base effects that we were going to get from last year, but still the number just smashed expectations. Yeah. So what happened? That triggered a spike in bond yields, and it triggered a sell-off in the equity market, particularly in the tech stocks. So if I share my screen, we can have a look at some charts. Here's the S&P chart. We broke down through that level. That big support level was around that 4130 area. We overshot quite a long way. 4100, 4095 was supposed to be a support. It didn't manage to hold. And we got all the way down to that support around 4040, right? 4042. So, we've been talking about the street gamma positioning and the fact that it was running out of gamma on the downside. It didn't have any gamma, particularly in the tech stocks. And that kind of helped exacerbate that move and that kind of liquidation type event. And then later on in the week, we managed to recover and managed to bounce and get all the way back pretty close to that 4200 level. And that was the area that we said the streets just flooded and choking on gamma on the S&P, basically, right? So that, if we went back up there, the odds were we were going to probably stabilize and gravitate towards that strike going into this Friday's expiry, because this is the May monthly expiry, because it's the third week of the month, third Friday of the month. So I would favor, now that we've managed to get back up here, there's probably a fair amount of dealer gamma keeping us up here, right? So you would need quite a big news catalyst to shake us away from these levels, right? So, you saw yesterday, we tried to sort of move down to around 4140, I think it was, if you look at those lows, 4143, I think was the low. And then the dealers came and bought back that delta that they needed to buy back, basically. So that took us, and we saw highs of 4185 today. So I just suspect throughout the rest of this week, we're going to be in that range of probably 4150 to 4200, maybe slightly above 4200 if we can get some momentum. But I think it's going to struggle to break violently away from that 4200 area. Okay. So that's kind of the price action, what's been going on S&P. On NASDAQ, you managed to hold on to that support, right? So I had said there was some support around the 1300 area, that kind of uptrend that's been in place for a while, and we kind of didn't really close below it. So managed to hang on to that, basically. So that was a good sign. But NASDAQ doesn't have quite the same vol dynamics in it. The street doesn't own as much vol and as much gamma in that, so it's a bit freer to move in theory, right? So bit hard to really call where that's going to go. If we do manage to stay here or grind up towards 4200, I wouldn't be overly surprised to see NASDAQ get towards maybe 13.5, 13.6. And that's probably an area where it would meet a bit of overhead resistance, because that'll be a retracement level of the recent sell-off. And then it will be a kind of wait and see what NASDAQ wants to do and what the yields are doing, basically, right? If we look at what the yields did, they spiked, 10-year yields spiked to around 170 last week on the back of that print. Got to highs of about 170. 175 is like the big level on the upside to break, which will probably trigger a bit more panic from the market. but we managed to stabilize and get all the way back down to here, which is 163. So yields for now staying relatively well behaved, despite the high inflation print that got people a bit spooked. Obviously, the Fed narrative continues to be transitory, nothing to worry about. But there's a lot of telltale signs that are making people look at the inflation and be a bit more concerned that it isn't so transitory. So some of the things that people are talking about and looking at from that perspective are inflation expectations, right? So for those of you who have done economics, inflation expectations are supposedly one of the main drivers of actual inflation, right? So if you look here, there's a University of Michigan sentiment survey on inflation expectations, and that came out, and that's absolutely flying, right? The inflation expectations. So, you know, it's one of those things, if that's a leading indicator for inflation, then that might be something to be a little bit more nervous and concerned about, okay? Now, some people will argue that, well, the jobs market isn't really on fire, so surely we can't get inflation, right? The Fed's staying loose, the Fed's staying easy because they want to get back to maximum employment, right? Now, the problem with that is that what's going on in the labor market is a bit special, right? So it's not a case of we don't have demand for labor. So it's not like the economy is suffering and we don't have demand for labor. The problem is we've got a bunch of job openings, but we've got no one to fill them, right? Because you've got a bunch of people sitting at home getting unemployment benefits and stimulus checks, and they're not incentivized to go and look for work. And what a lot of those people are actually doing is they are signing up to look for a job, but a job that they know they're not qualified to do, right? So you've got this mismatch in the labor market where to game the system and earn the unemployment benefits, people are basically applying for jobs that they're not qualified for, right? So this is the problem in the labor market. Because of the incentives that have been introduced by free money from the government, you've got this unhealthy situation in the labor market where it can't clear and it can't find the right price. And you've got this labor shortage, and small businesses are having to increase wages and offer bonuses to incentivize people to come and work for them, right? So that's actually inflationary. Yeah. So you've got this weird situation where you've got a load of people still unemployed, yet that's causing inflation, right? Which is quite an unusual dynamic, basically, right? And usually when wages go up, that tends to be more sticky inflation. So that doesn't tend to be as transitory, right? When you suddenly hike the wages that you offer people, it's harder to bring those back down, right? So that's something to kind of be aware of. And then you've also had earnings season, a bunch of conference calls on earnings calls where every CEO and everyone's talking about inflation as the major concern and the fact that they're gonna pass those costs on to the consumer. Yeah. So again, another indicator that inflation is on the forefront of everyone's minds and is going to get passed through. So we might not see it, and we are starting to see it in the CPI anyway, but the point is there may be a lot more to come, right? So you've got a CPI print of 4.2. Don't be overly surprised if you start seeing CPI prints in the 5-6 area over coming months, basically. Yeah. So now on the back of that, why is the Treasury market not going ballistic, right? Why are bond yields not going crazy if there's just so much information out there and commodity prices going up, PPI coming at 6-something%? Why is the bond market not completely falling out of bed? Well, two reasons. The Fed is there buying, yeah, and also spec positioning is quite short, right? So there's a fair amount of positioning in the market that is short, and that kind of prevents the market from absolutely collapsing, basically, because the marginal sellers already got short. Yeah. Another interesting thing last week was Stan Druckenmiller. So he's a great person to listen to. The way he expresses his sort of views on macro and stuff is so eloquent. He's obviously been a legend for God knows how many years in the market, right? So he's someone I always like to listen to. And he's been criticizing the Fed for keeping emergency policies going far beyond what was necessary. So, what the Fed did last March you know, you can have your debate as to whether or not they did the right thing, but those were emergency measures because we were facing a 100-year shock to the system. They needed to be done. But if you look at certain metrics like retail sales bounced, like they sold off hard on when the pandemic hit, but they bounced and recovered back to above their trend level very, very quickly by the summer, okay? And now they're at 15% above trend levels. Normally retail sales grow at like 3% a year or something, and they're 15% above trend, right? That's not an emergency situation, yeah? And why did retail sales bounce back so much? Because we were able to stay at home and buy everything on Amazon, right? So it's not like the kind of world we've moved into, the digital world, allowed us to keep having some kind of life and continue to spend money. And we were being given money by the government anyway, so we hadn't lost the income, so we could continue spending, and we just spent online, right? So that's why you got the recovery in things like retail sales much quicker, and why in theory we were out of the emergency state much quicker, right? But basically what he's saying is fiscal and monetary policy are completely inappropriate and inconsistent with the economic reality right now. Yeah. And on the back of that, he expects to see continued dollar weakness because of what they're doing, right? It's because they're losing credibility and they're just letting this thing run way too hot. And, you know, the foreign demand for treasuries has just been going down and down and down for a while, right? So this graphic here, so this shows the issuance of US treasuries versus who's buying them, basically, okay? And it goes back quite far. It goes back like 15 years. So you see back in the day, you would have spikes in treasury issuance. And if we break it into the colors, like who's taking that issuance down, you know, in the 2008 crisis or whatever, you had half of that issuance being soaked up by foreign buyers, basically. And then, you know, the other was split between banks, pension funds, households, and the Fed. And now you look at today, you've had this massive spike in issuance, but who's buying it? The Fed is buying more than half of it. Pension funds are buying pretty much the balance. Households and banks are buying a tiny amount, and foreigners are net selling. Foreigners aren't buying treasuries, right? So that is not a healthy situation for the dollar. And the reason why so many people are long-term bearish on the dollar is this, because if you've got foreign buyers of treasuries moving away from treasuries and parking their money elsewhere, then that demand for dollars is going down. And that's why the dollar continues to slide, basically. Okay. So that's what good old Stan had to say. Yeah. And, you know, the volatility last week in markets, both bond and equity, was slightly exaggerated by the fact that correlation between those two asset classes has been steadily going up. And so that becomes apparent when you look at this chart of the actual 60-day rolling correlation. So you can see here that whereas, you know, if we go back the past couple of decades, it kind of oscillates, or it has been oscillating between kind of 0 and minus 60%. Whereas, you know, post last year and the massive fiscal that we got and the response to Corona, you see this correlation has completely changed. And we're now looking at plus 0.5, right, which is like the highest we've seen since, you know, 2005, 6. And maybe even back in 2001. So you tend to get this situation when equities sell off, bonds are selling off with them, and the kind of, the risk parity funds that use bonds and equity in a portfolio to try and diversify, they don't get any diversification benefit. So the volatility of their portfolio is quite high still, and that triggers them to de-risk, right? So that's why when you do get bouts of vol, they can often get a bit exacerbated, and they can get quite, you can see those quite sharp spikes. So, you know, if we look at what the VIX did, so you see, if we look at what the VIX did last week, you know, once it broke above that kind of 21, 22 level, then we got this major acceleration where it started to pick up quite quite quickly, and it got pretty close to 30, right? It's topped out about 29, and that is basically because of this effect where you get this kind of high correlation between bonds and equity, and it's fueling this panic. But then, you know, as I always say, what goes up must come down, particularly in vol. It's like throwing up a stone in the air and you watch it, you know it's going up, but when it finally has decided it's done enough, it comes crashing back down to earth pretty fast, right? And we certainly saw that in the VIX collapse that happened over the course of the following kind of day or two and into the weekend. And usually when you see vol collapse so quickly and you see it give back the spike so fast, that is usually a sign that there's been some profit taking from people who had actually bought protection, who have bought vol or bought puts to protect themselves from a market drawdown, and they've now happily sort of monetized that, sold that protection back to the street, and then there's been an unwind of that kind of negative delta to the market. And then you start to see that reflexive kind of bid come back to the market where everyone's rushing to cover those shorts, and you see that volatility collapse back to the sort of pre-spike level, right? So this is what I call VIX gravity, and we certainly saw that happen at the back end of last week. Yeah. And then the sort of the other thing to mention would be China. The China chart here is showing us we were making lower lows in China whilst the momentum was trading higher, right? The lows in the momentum were getting higher whilst the lows in price were getting lower. And that's what you call a bullish divergence on momentum, yeah? And whilst you've also had bad Chinese macro data, that's slightly disappointing this week, the market still managed to rally, right? So I'm taking that as a short-term buy signal. And so I've dipped my toes in and bought China. So DXY breaking down, right? We've been talking about DXY, and you know it was kind of on those weekly supports, but now we can conclusively say it's broken that support and it's heading down. And then the next sort of, if you zoom out, the big picture support area is that 88 to 89 area where we're kind of heading towards now. Yeah. So that's going to be the real line in the sand, right? Because if that breaks, that opens up a massive amount of room. So if we zoom out here, if that zone breaks, then we've got room to 84 and then maybe even room to 80, basically, right? So then we're talking about some quite big moves in currencies on the back of that. So watch out for that because it looks like imminently we're going to test that zone in the dollar. And the reason why I've been saying the dollar's felt heavy, right? I mean, we had that risk-off move last week, and normally the dollar's quite strong in risk-off environment. But the dollar barely rallied last week. It just couldn't rally, right? So it's just the Fed's continued stance on this transitory inflation and that they don't want to lift off rates is undermining the credibility of the dollar. And that's why we're sliding. And I just think, watch out for that 88 zone, 88, 89 zone, because if that starts to break, then who knows what happens there. And then on the back of that, other currencies, you've got the pound popping its head above 142, which is a big level. That was where it kind of reached a peak back in February. But if you zoom out, I think on a lot of these currencies, we have to now start zooming out because we're reaching quite big levels on the long-term charts. And if you zoom out on the pound, if we can take out 142 convincingly, then that opens up the way to 150, right? So, and that's levels we have not seen since sort of pre-Brexit days, right? So that's kind of what we're looking at on the pound, right? Then commodities. So commodities have been pretty interesting. If we look at gold first, what have we been saying on gold? So gold took out the downtrend resistance. So gold had an 1860 level that was kind of the resistance of this downtrend from those highs last summer. And it's taken that out, or it's certainly looking like it's taken that out. And that opens up the way for a much bigger move in gold to the upside. Okay, so it looks like I've been proven wrong on my bearish gold bias. But thankfully, I just switched out of gold and into other commodities, which I thought were going to have a higher beta to the reflation narrative, whatever you want to call it. So I switched out of gold and into copper and oil and things like that. which has been fine, but it just looks like gold even itself wants to have a bit more of a rally, right? So the move, and I think it's because the move in inflation expectations is far sharper than I was expecting, and it's not been met with enough of a move in bond yields, right? So, and that's what's caused real yields to slide lower again, and that supported gold as well as the breakdown in the dollar. So you got the breakdown in the dollar as one thing driving gold higher, and you've got the real yield move going more negative, where inflation break-evens are just going through the roof and bond yields aren't really moving the way you would think they might. I mean, by now you would have thought 10-year yields would be at 2%, given what the inflation break-evens have done and what we're seeing in terms of inflation prints, inflation expectations, blah, blah, blah. But like I was saying, maybe that's a positioning thing. Maybe that's the Fed kind of not letting it go down. You know, there's who knows what the reason is, but yields just aren't moving along with inflation. And that's proving to be a good news for gold, basically. You know, I think the dollar testing major supports and the inflation numbers exploding, it would be dangerous to keep selling gold now. Now that it's broken out of that 1860 area, I'm not a seller of it anymore. If anything, I'm a buyer on dips, and buyer of calls maybe on dips could make sense because the vol's only at about 15. So if you think gold's got some real explosive price action maybe now because people kind of de-risked out of gold and it's going to suck in a bit more buying, it's going to catch some momentum, then you're not really having to pay the earth for like calls, which cost around 15 implied vol, right? So that might be the way to play gold. If you haven't already got some gold on board for the long-term book, then maybe you're going to be a buyer of calls on dips or something like that. But as long as it stays above those key levels at like 1860, yeah. And then silver kind of, I'd said that if gold rallied, we could see silver up at 28 again. It's actually gone higher than that. So, you know, now the question is silver going to get above 30, right? That was the big level that it hasn't managed to breach a couple of times. So this time around, a break of 30 will probably propel it to 35, 40 over the next, rest of the year. So that's going to be the big level to watch on silver is 30 if gold continues to rally, right? I do own a bit of silver in the long-term portfolio, thankfully. It's nothing huge, but it's there. It's part of my commodity portfolio. So I'm doing nothing with it right now, to be honest. I think sit tight and wait and see if that move comes. Longer term, always thought silver was probably going to catch a bit at some point. We're just trying to be a bit more opportunistic with the gold positioning because I thought that had some more weakness to come, but looks like that's not happening. Yeah. WTI oil, it's been kind of in a bit of a consolidation sort of wedgie pattern going on, triangle pattern here. If it breaks the top side of that, which is kind of between here and 60, 68, then the real move up to 75 is probably on, right? So obviously you've had various commentators like Goldman's or whatever talking about oil going a lot higher, global demand recovery, massive reduction in capacity, things like that, driving the fundamental story in oil. But that's kind of what we're looking at. If it can break above 68, that would be the one that gives you conviction that we're heading to 75 probably, right? So I own a little bit. I owned it since that kind of dip where it went down to the high 50s. I took a little scrap of profit. I've been running the balance with the trailing stops. Thankfully, I haven't been stopped out yet on the trailing stop because none of those pullbacks have been particularly deep. But, you know, maybe I would think about adding if we broke 68. If we broke 68, then, you know, it'd probably be at the same time that the dollar's breaking down. And it's kind of helping fuel the next leg up in commodities. Then it might be worth trying to play a tactical break of that 68 level to the upside. So I'll kind of keep an eye on that for myself. Plus oil, copper, the other big one in commodities that I've been tracking and trading. We're not trading, more investing, to be honest. So copper did have a bit of consolidation, nothing major. Obviously, I had this parabolic move from around kind of 4 all the way to 490 nearly. And then just off that last leg, doing some Fibonacci retracements, you see that we've managed to pull back to the 38, or sorry, the 61.8 retracement of that rally, and we bounced off it, right? So consolidation may be over, maybe not. I suspect it's probably got a bit more consolidation given the sheer velocity of that move up. So I wouldn't be surprised to see some more consolidating for copper over the next month or so. But the mega trend is well and truly intact in copper, right? The demand story. I mean, you had a bit of noise out of Peru and Chile talking about slapping some taxes up on copper, and maybe that's kind of triggered some of the weakness. But in general, you've got the mega trend in copper, the electrification of the world, of various parts of the economy, the fact we've got a major shortage of supply in copper because there just hasn't been enough capex, and that supply shortage is going to remain for a while, whilst the demand story is just going to get bigger and bigger, basically, right? So copper is definitely going to be a buy the dips on long term. In terms of where the dips are, I've kind of mentioned before, I put some basic retracement levels up for copper, which are 4.5, 435, 417. That would be a relatively shallow dip, in my opinion. Could we get a deeper dip? Possibly, but that would be a gift, basically, right? That would be a long-term gift that I would strongly recommend parking some long-term capital into. Yeah. And then the last thing to talk about in commods really is the grains. So grains has had the most ridiculous move to the upside, and finally they've started correcting. So, few of the top grains to kind of keep an eye on. Corn, again, that's some seriously parabolic move from end of March, went from 16.5 to 23. I mean, that's just insane. But it's had a decent sized correction off that move. Usually when you get these type of sort of third wave, Elliott wave, if you know Elliott wave, when you get these type of third wave type explosions and you start correcting off them, it's not just one correction and you're done. There's going to be probably some sort of consolidating that needs to be done in this market. So I'd imagine that's the first wave of the correction. You're going to get some sort of bounce, and then you're going to get the third part of the correction to complete it. So I'm not rushing in. I was long some wheat. If I bring up wheat, I was long some wheat. I've been trailing the stop on it, and my stop got triggered. So I'm out of my wheat for a nice little profit. I got involved down there at around 6, and I'm out around the high 6s. So these reasonable return. I'm not rushing to get back into these agricultural commodities right now. I'd be waiting to watch to see how the correction plays out. Also, unlike the copper story, whereas, the supply shortage is going to be there and the demand story is kind of intact and unlikely to change, I think it's a lot harder to kind of trade these ags because they're a lot more a function of things like the weather and things like how good the harvest is and stuff like that. Stuff that we've got no real clue about, and stuff that can be quite volatile and can change quite a lot, right? So I'm just watching and waiting on the ags because the move was a bit too parabolic for me, and happy to sort of wait and see what plays out there. Thanks for watching, guys. If you like this content, please subscribe to our channel, give the video a thumbs up, and hit the notification bell so you don't miss out on future videos. I'd also encourage you to sign up for a free trial to our live and interactive Macro Insight Zoom call. As part of our trading community, as well as the call, you'll also get access to our Telegram chat and our weekly market reports. To find out more, you can also connect with us on the socials. All the links are at our website, www.options-insight.com. Thanks.